For many years, I've always looked at chart patterns thinking they provide clear buy and sell signals. Things like triangles, flags, and head and shoulders seemed very simple. As long as the price formed the right shape on the chart, you knew a move was coming. At least that's what all the trading books told me. But over the past years, I've started to realize chart patterns may not be as reliable as they are made out to be. In fact, I'm beginning to think many of the classic patterns retailers like myself look for on the charts are intentionally set up by the smart money, specifically to trap retail traders. When I first started trading, I would eagerly scan charts looking for well-defined triangles, flags, double tops or bottoms, anything that resembled a textbook pattern. As soon as I spotted one starting to form, I would plot my entry and exit levels based on the targets described in most trading books. More often than not, the price would promptly reverse against me, leaving me scratching my head, wondering what went wrong. And at first, I blamed it on my inexperience. But it kept happening over and over with different markets. No matter how perfectly the pattern appeared, as soon as I took the bait, the move fell flat. I started to suspect the big players must be aware of these common retail strategies and were deliberately setting traps to liquidate our positions. It was around this time I first came across the idea of order flow manipulation. I discovered how institutions monitor retail order flow to see where we're concentrated. Then they engineer fakeouts in the opposite direction to flush us out. And at first, I didn't want to believe such a thing was possible. Sounded like a conspiracy. But the more examples I saw, the more it started to make sense. And if you're being honest to yourself, you know that retail chart patterns seem to not be as effective as they once were. These big institutions have immense resources and technology on their side. Is it really that far-fetched that they manipulate prices to profit at our expense? The answer lies in the subtle yet powerful influence of the smart money and how it manipulates the market. It might sound a bit harsh, but I believe this is an ongoing reality in the financial markets. The rich keep getting richer and the poor stay poor. And why does this happen? It's often due to market manipulation. So let me ask you, do you keep all your life savings in physical cash? Chances are you don't. Your money is sitting in various banks or large institutions. The banks are the ones who control the mass amounts of money. And banks, just like any other business, are out to make a profit. So it's safe to say that we and them have the same goal. But here's the thing. It takes a substantial amount of money to influence the markets. And these banks are the actual ones with the power to shape and steer prices as they see fit. The smart money has a few tricks up its sleeve. One of these tricks is stop-loss hunting. So let's consider this double bottom. Almost all traders set a stop-loss below the pattern, which automatically exit their position if the price reaches a certain level. But if enough people have stop-losses set around the same price, and the smart money can push the price down to this level, all the stop-losses will trigger at once, causing a rapid drop in price. The smart money can then scoop up these cheap prices before the market rebounds. Then there are market traps. This is when the smart money purposely creates a chart pattern, like a flag or a triangle, knowing that retail traders will see it and start buying or selling. Once the retail traders have taken the bait, the smart money goes the other way, causing the price to move in the opposite direction of what the retail traders were expecting. One of my most common mistakes was placing too much faith in chart patterns, and a lot of years I've ignored other key factors like volume, market news, or fundamentals, and I was instead relying solely on patterns to guide my trading decisions. And at first, I wasn't aware of liquidity runs, the main strategy used by smart money to quickly buy or sell large quantities of a market. They do this by pushing the price to levels where they know lots of orders are waiting, like the stop losses we talked about earlier, triggering them all at once. and creating a sudden surge in demand or supply that allows them to execute their large orders without drastically affecting the price. In fact, one of my biggest losses came after a chart pattern. A few years ago, I noticed Apple was forming a pretty obvious symmetrical triangle on its daily chart over the course of about 3 weeks. As the pattern developed, the stock was bouncing consistently between the upper and the lower trend lines. To me, it was a textbook, so I bought the next day the price broke out. And within a couple of days, without any clear news, the stock abruptly reversed its direction and plunged back below the breakout level. By the following week, it had completely negated the whole triangle move. And thinking back in hindsight, this was a liquidity run based on a classic retail pattern. Big players likely noticed a buildup of long retail positions from people like me reacting to the confirmed triangle breakout. Once our buys were established based on the pattern, they started selling into our stops, trapping us all with losses in the process. And with their vast financial capabilities, such an orchestrated price decrease wouldn't be hard to engineer and would yield massive profits at our expense. After seeing so many textbook patterns fail me in similar fashion over time, I've become increasingly skeptical that chart reading alone provides any real edge whatsoever at my retail level. Of course, technical analysis still has merit, but these strategies relying purely on pattern recognition seem hopelessly naive when factoring in the reality of order flow manipulation by the bigger players. Like I said, looking back, I was repeatedly taken for a sucker anytime I followed one of these textbook retail setups to the letter. Lessons learned the hard way. One of the patterns I got burned on repeatedly was the head and shoulders. It's supposed to be a very reliable reversal indicator, yet they would form only to promptly get invalidated by a big spike in the opposite direction soon as I entered. I clearly recall entering short positions multiple times as prices would break below the neckline, only to mysteriously reverse direction and move right back above it in no time. And another mistake I've made was not validating the breakout with the volume. Most breakouts below the neckline happened on low volume. These apparently staged fakeouts strongly suggest the pattern was deliberately engineered to attract our counter-trend shorts, only to be violently flushed out for a loss. Flags were other chart formations I used to consider, based on textbook continuation patterns. But much like the others, they fooled me too many times. The signals seem so cut and clear. Price pauses horizontally, consolidating its gains before resuming the prior trend. Yet, time and time again, as soon as I entered, assuming the breakout, the price would often reverse direction against me, often on relatively light volume. Like I said, those were valuable lessons I've learned. While retail traders like myself are busy scanning the charts, looking for textbook setups based purely on price, the bigger players are no doubt leveraging their much richer intel and experience to manipulate against our positions. With access to order information, sentiment readings, and many other data streams, they can pinpoint exactly where orders are concentrated and engineer fake moves to liquidate those positions. The reality is that our trading activity is completely transparent to them, and this allows them to set off liquidity runs with ease, conditions where temporary imbalances lead to sharp, irrational moves that defy any chart logic. So knowing this, how can we, retail traders, compete with the smart money? Are we doomed to lose every single time? The key is understanding how market prices move. Prices tend to gravitate toward levels where a significant number of unexecuted orders are waiting. These orders can be located either below or above the current market price, or sometimes both. The type of orders I'm referring to are buy stops, sell stops, stop losses, and trailing stops. In my personal approach to trading, I now prefer to identify general areas where these orders might be clustered on my charts. And when I notice a notable reaction from one of these areas, it often presents an opportunity for me to enter the market. Once pending orders have been triggered and liquidity dries up in a specific price area, it often leads to a reversal from the current levels. These reversals can frequently mark the low or high point of a trend, and finding your entry into the market can set you up for potentially significant gains with minimal risk. While this phenomenon can occur across various timeframes, it's more noticeable on smaller timeframes compared to larger ones. And from my experience, this tends to happen most frequently during the London trading session, in the overlap between the London and the US session. You have to ditch the retail mentality, the conventional approach of the retail trading presented in most trading books. Me personally, I seek buying opportunities where others are getting stopped out. Instead of following the crowd, I now prefer to take a contrarian approach. From my experience, markets often prove the crowd wrong, especially at price extremes. Therefore, aligning your position against the prevailing consensus can often lead to more favorable outcomes. My new mindset when I see a textbook pattern is that many stop-loss orders exist just below the market, and I know that smart money will try to run the market down to take out or activate the stops, and then run the price back up again. With this new perspective on the market, I encourage you to go back to your own charts and observe what happens in real market scenarios. For those of you who felt the frustration of being stopped out just before the market moves in your favor, despite correct analysis, you now have an explanation for why this occurs. Now you might ask, should we abandon chart patterns altogether? Not necessarily. While it's true that smart money manipulation can lead to failed patterns, this doesn't mean that chart patterns are useless. They can still provide some insights into market trends. However, it's crucial for us as retail traders to be aware of these tactics and not to rely solely on chart patterns when making our trading decisions. We need to remember that trading isn't just about recognizing shapes on a chart. It's a complex game involving numerous factors. We need to be flexible, adaptable, and always ready to learn. Understanding how smart money operates will help us become better traders. So keep an eye on those chart patterns, but don't let them be your only guide. So technical analysis still has value, but textbook chart patterns might be doing naive traders like my past self a great disservice. Signals that worked for decades are now intentionally manipulated precisely to bait and flush out unassuming retail positions. Classic moves like triangles, flags, and wedges have all personally failed me too many times to plausibly assign them the same credibility. As for myself, I aim to evolve beyond pure pattern reliance going forward, combining traditional chart tactics with order flow monitoring, sentiment analysis, and volume analysis for potential liquidity events has become my quest to level the playing field against smart money. So here are my key takeaways going forward. Trading isn't as simple as searching and recognizing different shapes. If it were, everyone would be rich. Markets can and will be manipulated to trigger stop orders. Retail traders don't have control over the price movements, but liquidity runs executed by smart money can present trading opportunities for us, retail traders. And always remember that prices tend to gravitate toward levels where a significant number of unexecuted orders are waiting.